Hello everyone. I welcome you all to Tech Mahindra's Q4 FY'25 results press conference. Before we begin, I would like to inform you that there will be a Q&A session at the end of the conference. Today we have with us on stage Tech Mahindra's CEO and Managing Director Mohit Joshi and Chief Financial Officer Rohit Anand. Without any further delay, over to you, Mohit.
Thank you, Leah, and good evening, everyone. I'm glad to be here today with all of you for the results announcement. In addition to the updates from the most recent quarter, Rohit and I will share the updates from our strategic roadmap that began a year ago. We will talk about the progress that we have made over the last year and how we see the next 2 years shaping up. Let me first brief you on the performance for the quarter and for the full year and our FY'25 performance. We closed the year with a revenue of $6264 million with a 0.3% growth on a constant currency basis. This year's stable revenue performance comes after absorbing more than a 1% top-line reduction from our strategic decision to scale down non-core and loss-making businesses, and this really contrasts with a 5% decline in the last financial year. Importantly, we achieved the goal we set for ourselves to stabilize the organizations, to stabilize key accounts, and this marks a key milestone in our turnaround journey. Our operating profit for the full year stood at $607 million, a 60% year-on-year growth. We expanded margins by 360 basis points to 9.7%, primarily due to improvements in operational efficiencies and savings from Project Fortius. Let me provide some flavor on vertical-wise performance for the full year and on a constant currency basis. The BFSI vertical grew by 5.2% as we continue to scale up on our new logos, as well as the deepening engagements with existing clients. This reflects the progress that we are making on our strategy to drive better growth and to diversify our mix across segments. The retail vertical grew by 4.5%, led mainly by volume expansion and new client acquisitions. The healthcare vertical grew by 3.4%, backed by deal wins, and continues to be a key focus vertical for us. The manufacturing vertical declined by 1%, with year-on-year growth in the first half of the year, offset by continued weaknesses in the auto sector during the second half. Still, we are very happy with the efforts that we're making in this vertical to expand our client base and our geographic reach, which we think better positions us for growth down the road. The comms vertical declined by 4.2% as the industry headwinds due to a prolonged downturn in the sector. However, we are now seeing signs of stability returning, most notably in Europe and the Asia-Pacific region, with evidence in our bookings activity and in our pipeline. High-tech has remained flattish for the year. The momentum tapered off in the second half, with the outlook turning cautious, particularly in Q4, due to macroeconomic pressures. In terms of geography, while the Americas saw a decline by 2% on a constant currency basis, Europe remained flat for the year, and the ROW region grew by 5.9%, led by growth in our prioritized markets in APJ on a constant currency basis. Our deal wins for the full year stood at $2.7 billion, a growth of 42.5% year-on-year. These deal wins are broad-based across our key industries and our prioritized markets. Our focus is on achieving profitable growth by offering proven solutions to clients to produce deals that are healthy for both the clients and for TechM. We are not taking on speculative deal risks. For the quarter, we reported revenue of $1.549 billion, a growth of 0.3% year-on-year on a constant currency basis. This performance was impacted primarily by delay in customer renewal decisions for a US high-tech client, along with the seasonal trends in the retail vertical and the BPS segment. We expect that this will correct over time. The comms business grew by 1% sequentially, supported by Comviva seasonality, and as stated previously, the stabilization of telecom spend in Europe and APAC. BFSI growth is underpinned by early recovery signals in discretionary spending and the investments that we are making in engaging with BFSI clients in a more consultative way. Manufacturing remains soft, especially in the automobile sector. However, we continue to address industry challenges such as high operational costs, process inefficiencies, and supply chain disruptions with the launch of an advanced manufacturing experience center at our campus in Chennai. This center will help customers quickly prototype and scale AI-driven innovations in a low-risk environment before implementing them on a larger scale. This accelerates the development cycles by allowing businesses to assess the return on investment and improve their operations in a controlled setting. I would really welcome all of you to visit the center and to experience our capabilities in the manufacturing vertical firsthand. Despite these headwinds, our operating margin for the quarter stood at 10.5%, an expansion of 310 basis points on a year-on-year basis and 40 basis points sequentially. You would recall that during the release of our strategic roadmap last year, we had announced that one of the focused areas of investment was the expansion of our service offerings and in-house capability building. Pursuant to that, we are excited to announce the launch of our latest service line, that is TechM Consulting. Through this offering, we aspire to be a trusted advisor and a growth partner for our clients based on our ability to support their evolution and transformation. TechM has had a highly experienced staff that stands out in the services industry, given that many other players have recently emphasized more junior staffing models. This strong experience and tenure of TechM staff is a differentiator that gives us a ripe opportunity to increasingly serve clients in consulting and advisory roles. Our experienced staff gives us the right to play more consultative roles, and we are leaning into this by formally launching TechM Consulting. Arjun Saxena has joined us as the head of TechM Consulting. He's a seasoned veteran with 28 plus years of experience in business and technology consulting. We are also pleased to welcome Scott Sorokin, who has joined us to spearhead our company's digital transformation and experience design initiative. During this year, we invested in building a strong leadership foundation through key hires across our prioritized markets and our service lines. With this, we are well positioned to drive the next phase of our strategic roadmap. As you may have seen already in our press release, we have also launched our comprehensive suite of AI offerings with a renewed strategy of AI delivered right. I will cover this in a little bit more detail in my presentation and walk you through the core pillars of this proposition. Our large deal TCV for the quarter stood at $798 million, taking the last 12 months TCV wins to $2.7 billion. Like I said previously, this is a 42.5% year-on-year growth. This also includes two large deals that we signed in Q4, each over $100 million in TCV. Notable deal wins this quarter include a large deal with a tier 1 US-based telco. This deal positions us as one of the largest one-stop device test and certification labs for the US market, with the ability to support global smartphone OEMs, IoT module makers, and chipset manufacturers focused on launching 5G and next-gen wireless-enabled devices. TechM was also selected by a leading American telco to enhance customer experience, reduce churn, and improve efficiencies across its wireless and wireline service offerings. We won a deal with a global leader in enterprise applications to provide managed TechOps services for end customers of its flagship enterprise platform, handling end-to-end journey of build, migrate, operate, and decommissioning in the private cloud infrastructure. We were selected by a US-based healthcare company providing public health solutions to the Medicaid population for a CMS interoperability mandate. TechM will be the reseller, implementation, and support partner of the SaaS interoperability solution, helping the client onboard their customers seamlessly. We won a deal with a leading US-based global aerospace company in the compute infrastructure space that involves managing compute instances using advanced technologies like containers as a service and platform as a service. TechM was selected by a leading retailer in the US to serve as a strategic extension of its technology team. This involves establishing a global engineering center for data and for insights that will act as a hub to implement advanced analytics and AI-driven programs for the client. These are some examples of deals that feature TechM in roles where we are serving clients as a strategic partner rather than acting as an outsourced vendor. We continue to grow and expand our partnership and alliances with ecosystem partners. I would like to highlight a few notable strategic partnerships that we announced during the quarter. We built a pharmacovigilance solution with NVIDIA, AI software and powered by TechM's Tenor framework to advance drug safety management by leveraging agentic AI and automation to enhance the accuracy, speed, and efficiency of pharmacovigilance processes. We expanded our long-term strategic partnership with Google Cloud to boost the adoption of AI and to lead digital transformation globally, combining TechM's deep domain expertise with Google Cloud's AI capabilities, AI development platform, and agentic AI technology. We announced a strategic AI-led collaboration with Qualcomm Technologies through the successful integration of our proprietary AI model IndusQ LLM into Qualcomm AI Hub. It's the dedicated platform for on-device AI model deployment, placing TechM as the only GSI to achieve this integration. At TechM, we announced our membership of the AI RAN Alliance, a global initiative committed to fostering the development and deployment of AI-driven solutions within radio access networks, enabling us to help our customers, enterprises, and partners navigate the evolving telecom landscape. Rakuten Symphony signed MOUs with Tech Mahindra, Cisco Systems, and Airspan Networks, enabling Airspan and TechM to resell Rakuten Symphony Open RAN software licenses to telcos and enterprises globally. TechM will also serve as the preferred integrator for Rakuten Symphony. Tech Mahindra secured the first ever licensing agreement for Cricket Wireless, an AT&T-owned leading prepaid wireless provider, point of sale systems, Activate, enabling TechM to integrate it into its comprehensive suite of solutions for wireless service provisions globally. TechM also garnered encouraging accolades and recognitions for its people policy and sustainability practices. I think a few notable recognitions that I'd like to mention here are we were recognized with the Gold Award for the Best Tech Team of the Year, organization using HR Tech at the BW People Tech Future Awards 2025. We won the awards for our exceptional efforts in ESG arena, including a validation by the Science Based Targets Initiative for net zero goals. We generated a free cash flow of $150 million in Q4 FY'25, in line with our capital allocation policy. The board has recommended a final dividend of rupees 30 per share. This brings the total dividend for FY'25 to INR 45 rupees per share, a dividend payout ratio of 104%. This represents an increase of rupees 5 per share over the previous year, marking a 12.5% growth in the dividend per share. As we enter FY'26, we remain steadfast in achieving our stated goals. While global economic conditions continue to present challenges, we believe the foundational work that we have put in will help us to navigate the evolving landscape. We remain mindful of the volatility, but our focus on disciplined execution and resilience across our core strategies keeps us well grounded. With this, I now hand it over to Rohit to take you through the detailed financial performance of the company. Being the only Indian IT company in the top 5% of global sustainable companies and being placed on the A list for CDP climate change and CDP water stewardship. Rohit, over to you.
Thank you, Mohit. Good evening, everyone. Let me cover the company financials in a little bit more detail for the quarter and the year ended March 2025. We ended the quarter with revenue of $1,549 million versus $1,568 million the previous quarter. On a reported basis, revenue declined 1.2 sequentially and remained flat on a YOY basis. On constant currency, the decline was 1.5 sequentially and 0.3 growth over a YOY basis. The sequential decline in revenue is primarily driven by delay in the closure, as Mohit mentioned, of a renewal deal in US high-tech customer, which we feel will come back over the next few months. In INR terms, the revenue stood at 13,384 crores versus 13,285 crores in Q3, a growth of 0.7% on a sequential basis and 4% on a YOY basis, on the back of favorable foreign exchange movement. Q4, communication vertical grew 1% sequentially, supported by the Comviva seasonality. BFSI, one of our focus vertical, grew by 2.4% sequentially and by 6% on a YOY basis, and on the back of the recent deal wins. Manufacturing declined by 0.2% QOQ on account of weakness in the automobile segment. High-tech vertical saw an 8% decline QOQ, and the reason stated earlier, while reporting a 4% decline on a YOY basis. Our deal wins, as Mohit mentioned, stood at 798 million, which is significantly up YOY. This marks a continued acceleration in our deal win trajectory. Our deal wins have been broad-based across verticals and geographies. Coming to profitability, we reported EBIT of 163 million for the quarter. This is an increase of 2.8% from a QOQ perspective and 43.6% from a YOY perspective. The EBIT was 1,405 crores in INR terms. The margin for the quarter stood at 10.5%, which is an expansion of 40 basis points on a QOQ basis. Main margin walk items are, we announced wage hike in the quarter, which had an impact of broadly 1% on the margins, which was offset by operating efficiencies and actions under the Project Fortius, driven by various levers around offshore mix, subcon optimization, and other cost levers. Comviva seasonality and a favorable FX mix also helped from a margin on a quarter basis. This quarter, our effective tax rate was low due to some one-time benefit at 22%. And on a full year basis, our tax rate was 24.8%. Looking ahead, as previously guided, our ETR will normalize in the range of 26 to 27%. Our PAT stood at 136 million, an increase of 17% and a 71% increase from a QOQ and a YOY basis, respectively. In INR terms, PAT was 1,167 crores, and PAT margin for the quarter stood at 8.7%, an expansion of 130 basis points sequentially and 350 basis points on a YOY basis. As Mohit mentioned, we generated a free cash flow of 150 million for the quarter, supplemented by a good DSO performance of 88 days, which was similar to last quarter, and an improvement of 4 days versus last year. The total hedge book for the March 31st stood at 1.96 billion versus 2.1 billion last quarter. And based on hedge accounting, the mark-to-market gain for the quarter was 5.9 million, out of which 0.8 million was taken to the P&L as loss, and the rest was carried as a gain of 6.7 million to reserves. Moving to the full year's performance, the revenue stood at 6,264 million at constant currency growth of 0.3% and a decline of 0.2% on a reported basis. In rupee terms, revenue was 52,988 crores, a growth of 1.9%. On full year and reported basis, BFSI delivered a strong 4.3% growth, supported by new logos win and indicating steady progress in the industry. HLS and retail grew 3.7% and 4.4% respectively, reflecting sustained client demand and strong execution. High-tech has been flat for the year, and manufacturing declined by 1% due to softness in the automobile segment more towards the second half of the year. Com vertical has seen a decline as the industry focused on cost optimization and reducing discretionary spending. We remain focused on long-term value across all verticals. The TCV wins for the year is 2.7 billion, which is a growth of 42.5% on a YOY basis. And more importantly, significant portion of these deals are multi-year and strategic deals to drive client transformation agenda. EBIT stood at 607 million, which is an increase of 60% in USD terms. In rupee terms, EBIT was at 5,138 crores. The resultant margin was for the year 9.7%, which is an expansion of 360 basis points. We generated for the year free cash flow of $613 million, and we ended the year with a cash and cash equivalents of 896 million. In line with our capital allocation policy, the board has recommended a final dividend of INR 30, taking the total dividend for the year announced at 45 rupees per share. The resultant dividend payout ratio stands at 104% of PAT and 122% of FCF. Now I hand it back to Mohit for closing comments.
Yeah, perfect. So I guess we can start with the Q&A session. Thank you, Rohit. Thank you for that detailed analysis.
We'll now conclude this stream for those who have joined us on social media. Thank you everyone for joining us.
Yeah.